Should you wait for saving more deposit for your first real estate and next investment, or should you pay less deposit by considering LMI in your loan process? In today's video, I will be discussing the consequences of using higher deposit and lower deposit depending upon different financial situations. And let us see if LMI is our friend or should we stay away from LMI. And in what kind of situations LMI can help us in getting into the real estate market quicker, and in other situations where we should totally stay away from LMI. If you are interested in knowing my thoughts, keep watching. Hi guys, this is John from Admire Property Group. I'm running an independent buyer's agency where we help people in buying high performing real estate asset that grows in value with time and gives a good rental income and cash flow, basically making it a self-sustainable investment that doesn't put a lot of pressure on your finances and navigates you to the financial independence eventually. And welcome back to another episode on my channel where I talk about real estate, financial literacy, financial independence, and passive income. And if you are new to this channel, make sure you click on like and subscribe so that we can spread this information to more people using YouTube algorithm. So let's start with LMI. So the first question is, what is LMI? LMI stands for Lender's Mortgage Insurance. So LMI is an insurance premium that you pay when you consider taking a loan more than 80% of the purchase price. As you go from 80% to 95%, LMI keeps on increasing. And from 80% to 88%, it increases at a lower rate. From 88% to 95%, it increases exponentially. So 88% or 90% can be considered as a sweet point for the LMI. And most of the times investors go for 90% LVR ratio because at 90%, the LMI comes out to be roughly 2% of the purchase price. Although you are paying the insurance premium, but it is not giving any protection to you against anything, rather than it protects the bank if something wrong happens. For example, if you are unable to make the payments, it will protect the bank, but the bank passes on these costs to you to protect themselves from any mishappening. Some of the bank insure their loan even if they are giving 80% of the loan, but in that case the premium gets paid by the bank, not by you. And in most of the cases, LMI is the insurance for the lender when they are giving you more than 80% of the loan to protect themselves, but their premium gets paid by you, not by the bank. Now, the next question arises, is it worth paying LMI? Because it's not giving you any protection against anything, rather than it's increasing your costs. It's getting added to your loan. LMI can be considered as a slingshot in real estate. Imagine using a slingshot to hit a target which is too far away. So hitting the target can be done in two ways. The first way is you use your own strength to hit the target. That will take a lot of efforts. And the other way is you use the slingshot, and with the tension of the elastic band, you can hit the target without you using your own strength. So the tension in the elastic band helps you reaching the target with lower strength. So in a similar way, LMI in real estate helps you increasing your buying power. That helps you in buying the property with lower deposit. So now the next question arises, should we go for LMI every time we buy an investment property? The answer is no. It depends upon your financial scenarios at that time. We will be discussing different financial scenarios which will help us in deciding should we go for LMI in that scenario or should we avoid LMI. So the next question is how the LMI is paid. So LMI can be paid in two ways. It can be paid upfront out of your pocket, or you can capitalize the LMI in your loan. So it will be spread over next 30 years. So means you will not have to pay it from your pocket upfront. Now you will say that you will pay more interest by adding LMI into your loan. But the benefit to this is you will go into the market quicker where the growth is a lot higher than the amount you pay as LMI. And moreover, you can refinance, you can pay your debt faster, or you can take the equity out to reduce these costs of LMI. LMI can be amortized and written off in next 5 years. It means you can claim LMI as tax deductions in next 5 years. And the other option is if you have got a good capital growth in your purchase and you want to take the equity out and refinance and buy for your next investment, then you can claim this as a tax deductions in your interest expenses as well. And please, please, please don't take this advice as a financial advice, because I'm not a financial advisor and even I don't look like a financial advisor. So make sure you talk to your accountant or a relevant professional before you take any decision. I'm just a random person giving you the information in this video without knowing your personal circumstances. And if you wait to save more money rather than using LMI, you will be out of the market for a longer time and you will miss the opportunity of taking benefit from leverage and compounding during that period. As I said in the start of my video that we will be discussing different scenarios depending upon different financial situations. Now I will take you to my screen and we'll start discussing those scenarios. Let's go to the scenario 1. In scenario 1, imagine you have got $80,000 savings and you want to buy a property of $500,000. So out of $80,000 for a purchase of $500,000, you will have to keep $30,000 as acquisition cost. That would include like stamp duty, conveyancing cost, inspections, and any other professional fees which you pay. And then you will be left with $50,000, which you can use as a deposit for a purchase of $500,000 property. So this comes out to be 10% of the total value. So in this scenario, as you have got 10% deposit of the purchase price, you have got two options. The first option is you will have to wait so that you can save another $50,000, and considering like you are saving $1,500 in a month, so it will take another at least 3 years for you to save another $50,000 so that you can get $100,000 as a 20% deposit for a purchase of $500,000. So considering the growth as 5% as a conservative growth for the area, if you wait for 3 years, the market value of that property of $500,000 will become $580,000 in 3 years. And most of us in these days, it becomes difficult for us to save $1,500 per month. But if you are earning a lot of money, you can save $80,000 in 1 month or 2 months time. You can wait and buy a property afterwards. And the next option which you can consider is taking LMI. So in this case, if you take LMI, your loan LVR would be 90% and you will be getting roughly $10,000 as LMI, which would be approximately 2% of the property value. So by taking $10,000 LMI or consolidating that $10,000 into your loan, you can buy this $500,000 property today, and in another 3 years the value of the property becomes $580,000. So your net gain will be $80,000 minus $10,000, so that equals $70,000. So in any case, you are further away by $70,000 if you go for LMI in this option. So my question to you in this scenario is, would you rather wait for another 3 years to save another $50,000 so that you can buy a property of $500,000, or would you rather include $10,000 in your loan as LMI and buy this property today, or would you take a benefit of $80,000 growth in equity in these 3 years? And if you are buying a property in an area where it is not growing more than 2% of the value, then you should not consider buying this property at all. So you should be confident in the area where you are buying this property. You should be very confident about the location and other data factors, and make sure that you get at least 5% growth, because if you are not getting that kind of growth in the area, it's not worth investing your money in this property. And make sure you give me the answer of my question in the comments below. So coming to the next scenario, I will use the same example. If you want to buy a property of $500,000 and you have got $130,000 in savings, so considering the $30,000 as acquisition costs, you will be left with $100,000 that can be used as a 20% deposit towards the purchase of a $500,000 property. So in this scenario, you should ask yourself a question: how much is your borrowing power? Is your borrowing power for $500,000, or can we go for a borrowing power of $1 million? You should go and ask your mortgage broker, because if your borrowing power is only $500,000, then you should definitely pay 20% deposit towards the purchase of the property and don't pay any LMI, because in any case it will add additional cost to your loan and you will be paying extra interest on it. So in this scenario, if you are buying this property of $500,000 with 20% deposit, you won't have to pay any LMI. And if you take a conservative growth of 5% for this property, in next 10 years, the value of this property becomes $814,000. And if you have taken a interest only loan of $400,000 and considering that your loan stays the same in 10 years, and the equity which you can take out of this property after 10 years is $415,000. And if you extrapolate these numbers to another 20 years, 30 years, I'm telling you, it will make a big difference in your equity by considering 5% growth in all those 10, 20, 30 years. Now the next scenario, you have checked with your mortgage broker and you have the borrowing power of $1 million. So in that case, rather than using $100,000 deposit as a 20% deposit towards the purchase of $500,000, what you can do is use $50,000 as a 10% deposit towards the purchase of $500,000 and use another $50,000 towards the purchase of another property. So in this case, you will be getting an LMI of $10,000 which will get added to your loan. But in that scenario, if you are investing in two different properties with $100,000 as a deposit, 10% towards first property and 10% towards second property, mind you, you will have to organize another $30,000 as acquisition cost for the second property. But if you can do that, so by investing $100,000 into two different properties as a 10% deposit, let's see what the numbers comes out to be. So in this scenario, you have bought two properties, $500 each, and if you take the growth as same as 5%, in 10 years the values of your property will become 1.62 million. And considering the initial loan of $450,000 for each property, the initial loan would be $900,000. So in that case, if you buy two properties, the value of those two properties in 10 years becomes 1.62 million. The loan is $900,000, and the equity which you have gained in those 10 years would be roughly $720,000. So by investing the same deposit in two different properties, now your equity is $720,000, which was only $414,000 in first case. So you can see a big difference in your equity in 10 years, and this difference is roughly $300,000 by using LMI as a slingshot. And if you extrapolate these numbers to another 20 years, 30 years, I'm sure you can calculate these numbers, and these numbers would be absolutely amazing. If you take the example of these 10 years growth in both the cases, in first scenario, you are earning roughly $40,000 per year as equity in the first case, and in second case, you will be getting another $72,000 as a passive income per year from the capital growth of those two properties. So this is a big difference in the equity. And now coming on to the cash on cash returns. So cash on cash returns are calculated as, like, if you invest $1 in some deal, how much are you getting back? So in case of banks, if you are depositing $1 in the bank, most of the banks will give you 4% or 5%. So in 1 year's time, you will get 5 cents on top of that $1. Now let's calculate the cash on cash returns in these deals. In the first case, where you have bought one property, the cash used is $100,000 as a deposit and $30,000 as acquisition cost, so $130,000 in total. And the equity which you have gained in 10 years is $414,000. So the cash on cash returns in this case is 318%, which is like 3.2 times. So you're putting $1 and you are getting $3 back in that deal. And on the other side, in the other scenario where you have bought two properties, by considering another $20,000 as LMI for those two properties, the cash used in that scenario is $100,000 plus $30,000 for first property acquisition cost, $30,000 for second property acquisition cost. The total cash used is $160,000, and cash on cash returns on this scenario in 10 years is 450%, which is like 4.5 times, a lot higher than the first scenario. So this is how you can take the benefit of leverage of bank's money to increase your cash on cash returns and taking a good benefit from the equity of the properties in 10 years, 20 years, and 30 years. So in this scenario, if you got $130,000 or $160,000 savings in your account, it depends upon you whether you want to earn $40,000 per year as a passive income as a capital growth, or you want to earn $72,000 as a passive income as a capital growth. It depends upon you. So if you have good savings and have good borrowing power, you can consider any of these situations and can go for good growth in your property portfolio. Whether you go for one property or you go for two properties, it depends upon your risk appetite. If you have got a higher risk appetite, you are more aggressive in the real estate market, you can go for two properties and can take a benefit of 4.5% cash on cash returns. Or if your risk appetite is low, you can go for one property and can take a benefit of 3% cash on cash returns. On the flip side, if you have got the savings or equity but don't have the borrowing power of buying two properties, it's better to buy only one property. So in that situation, it's better to stay away from LMI and don't pay anything in LMI. Just use 20% deposit to buy the property. And I hope this video has given you good information about LMI, that how you can use LMI as a slingshot to get to your target faster. And if you like this video, make sure you click like and subscribe and share it with your friends who are in the same boat, and this information might help them in getting to the property ladder faster. And for today, I'll sign off and we'll see you in my next video. Happy investing.